I want to speak about index funds and ETFs. There are two forms of management with respect to equities, for example, with respect to stocks. Active management, which means buying and selling securities and overweighting them versus the index or underweighting them based on the belief that this stock would outperform the index or that this stock has better potential than another stock and therefore one should own more of that stock as opposed to another stock. That's active management, where decisions are taken by a portfolio manager. Or passive management. And passive management means holding the stocks in exactly the proportion that they're represented in the index. For example, the S&P 500, a passive equity management strategy with respect to the S&P 500 would mean holding all of the stocks in the S&P 500 or a very large proportion of the stocks in the S&P 500 so that the performance of the fund very much tracks the performance of the S&P 500. And an index fund, therefore, that being an index fund, i.e. holding the stocks in the proportion that they're held in within the index, is a passive strategy, and it basically follows the belief that active management does not lead to consistent outperformance over longer periods in developed markets, and through passive management one can save fees because a lot of the portfolio management is done through computers, and by replicating the index, a better performance can be achieved through lower fees and because of the belief that active management over longer periods would actually underperform the index because markets are informationally efficient. So index funds hold the stocks in exactly the proportion that they're held in within the index, and that can be any index. So one could have a DAX, for example, the German index, the DAX. One could have a DAX index fund. One could have an S&P 500 index funds. And these are index funds, i.e. they hold the securities in exactly the proportion that they're held in within the index, and they represent a passive management strategy on the belief that markets are informationally efficient and on the belief that one can save on fees, and therefore one is at least sure of having lower fees, which then add back to performance, and therefore one should end up with a better performance. And index funds are available through many providers and represent a very interesting way of getting exposure to a broader market. Now, somewhat tied to index funds are exchange-traded funds. And exchange-traded funds are funds that often are related to an index. So they could be, for example, an S&P 500 index fund, effectively, that then is securitized to trade as a fund on an exchange, as the name suggests. So an exchange-traded fund is a fund that trades on an exchange that can be readily bought or sold, and that delivers the performance typically of an index, and that would be also included in the name of the exchange-traded fund. So an S&P 500 exchange-traded fund would largely replicate the performance of the S&P 500 in the form of a securitized instrument known as an ETF. And the advantage of an ETF or an exchange-traded fund is that one can readily buy and sell the exchange-traded fund very quickly. So hedge fund managers, for example, would use exchange-traded funds to buy or sell different indices over very short time periods in order to capture what they think are inefficiencies in pricing. Whereas subscribing to an index fund or putting money into an index fund is a longer-term process where typically money is only taken in once a day, and where the subscription process is much more laborious than buying or selling a stock, which can be done very readily through an exchange-traded fund and getting that exposure to that index. Where